Hello and welcome. Today we're going to demystify a really important provision, especially for those in the energy sector. We're talking about Section 49 of the Income Tax Act 2025, and we're going to break down exactly how the Site Restoration Fund works. So let's start with a big question, a real puzzle for any major oil or gas operation. You know that years, maybe even decades from now, a massive cleanup bill is coming your way. So how on earth can you get a tax deduction for that future cost today? Well, that is precisely the problem that Section 49 was created to solve. Okay, here's how we're going to tackle this. First, we'll look at the why, the restoration obligation itself. Then, we'll dive into Section 49 as the solution, get into the nitty-gritty of claiming the deduction, run through a practical calculation, cover the all-important compliance rules, and finally, look at what happens when you actually need to use that money. Right. Let's set the stage. Why do we even need a provision like this? Well, it all starts with a very real and very significant future liability. You see, companies that are extracting petroleum and natural gas can't just pack up and leave when a site is done. They are legally and environmentally bound to clean up, safely shut everything down, and restore the land. And let me tell you, this is not a small expense. We're talking about a massive future liability that has to be factored into their long-term financial plans. The government recognized this challenge, and that's why they created a specific mechanism to help these businesses get ready. And that brings us right to the solution, Section 49 of the Income Tax Act 2025. This is the government's strategic answer for pre-funding that huge future obligation. So what in the world is a site restoration fund? Honestly, the easiest way to think about it is like a special government-approved piggy bank. The money you put into this piggy bank for those future cleanup jobs can be claimed as a tax deduction in the current year. It's a really powerful tool for financial planning, but as you're about to see, this is one piggy bank that comes with some very, very strict rules. Now, for all the seasoned professionals out there, this whole concept probably sounds pretty familiar, doesn't it? And you'd be right. Section 49 of the new 2025 Act is basically the direct successor to the old Section 33 ABA. The core principles, the whole mechanism, it's all the same. The main changes are really just updating the language, like using tax year instead of the old previous year. Okay, so who gets to take advantage of this special fund? Well, Section 49, subsection 1, is crystal clear. It's for businesses involved in prospecting, extracting, or producing petroleum or natural gas right here in India. And the key thing is you absolutely must have an agreement with the central government for these activities. It's a very targeted provision for a very specific industry. So you're eligible. Now what? How does this actually work in practice? Let's break down the mechanics of claiming this deduction. The very first thing you need to grasp is that this deduction isn't a free-for-all. According to Schedule X, the amount you can claim is the lower of two figures, either the amount you actually deposit into the fund or a cap set at 20% of your business profits. And paragraph 2 of Schedule X gives us a nice, clear three-step process. Step 1, you have to deposit the money into a special, specified account before the tax year is over. Step 2, get your business accounts audited and get a very specific audit report. And finally, step 3, you furnish that report and officially make your claim on the tax return. It's a straightforward, compliance-heavy process. All right, theory is great, but let's make this real. A quick calculation will show you exactly how that lower of the two rule plays out in the real world. This table just makes it so easy to understand. Let's say your business profits are 10 crore. That means our 20% cap is 2 crore. Now look at scenario A. Here, the company deposits 1.5 crore. Since that's lower than the 2 crore cap, they can deduct the whole thing. Easy. But in scenario B, they deposit 2.5 crore. Now, because that's over the 2 crore cap, their deduction gets limited to that 2 crore ceiling. It's a perfect example of how that limit actually works. As you know, with any tax benefit, compliance is everything. So let's talk about the specific conditions you have to meet and the paper trail you need to follow. Schedule X lays down some absolute non-negotiables. First, the timing. The deposit has to be made before the tax year ends. No exceptions. And where the money goes is also specific. It has to be in a specified account, which means either a special account with the State Bank of India or a site restoration account. And you can't just pick any old scheme. It has to be one that's officially approved by the Ministry of Petroleum and Natural Gas. When all is said and done, your compliance really comes down to one absolutely crucial document, the audit report in Form number 183. This is mandated by Rule 291. And to put it bluntly, no form, no deduction. It is the single key that unlocks this entire tax benefit. So what happens down the line when it's finally time to use this money? Well, you guessed it, the rules around withdrawals are just as strict as the rules for putting the money in. This slide does a great job of comparing the two paths. On the one hand, if you use the money for approved business expenses under the scheme, you're golden. But here's an important catch. You don't get to claim that expense as a separate deduction. That would be double dipping. On the other hand, if you misuse the funds, that withdrawn amount is immediately treated as business income and becomes fully taxable. And you really need to watch the timing, because this also happens if you withdraw for the right reason but don't actually spend the money in the same tax year. So just to recap, these are the three main triggers that will make a withdrawal taxable. First, using it for something that's not in the approved scheme. Second, closing the account. Any money left over gets taxed as income. And third, that timing trap we just mentioned. You withdraw for an approved purpose, but you fail to actually spend it within that same tax year. This is a critical point for anyone managing compliance here. All right, we have covered a lot of ground today. So let's just pull everything together and highlight the most important takeaways from our explainer. So let's nail this down. Remember, Section 49 is your tool to get a tax deduction now for a future cost. The deduction is capped at the lower of your deposit or 20% of your profits. Compliance is king. That Form 83 audit report is absolutely mandatory. And be careful how you use the money, because any misstep turns it into taxable business income. And for all you veterans, just remember, this is the new address for the old Section 33 ABA. It's a really powerful way to align that long-term environmental duty with smart financial strategy. We really hope this deep dive into Section 49 has been helpful for you. If you got some value out of it, please do us a favor and like, subscribe, or share it with your network. Thank you so much for watching. Just a reminder, this presentation is for educational purposes only and is not professional advice. Tax laws are always subject to change, so please consult with your professional advisor before taking any action. This is an AI-generated educational explainer.